Good evening, everybody, and welcome to this panel on the challenge of trying to normalize monetary policy after the pandemic. You know what's happened. Very heavy quantitative easing being used, pandemic emergency programs, interest rates at rock bottom levels for nearly a decade. This is highly unusual, and it raises questions of how do you go back to the normal, whatever normal means. Normal has been further disrupted by the uncertainty that's inevitably going to arise because of what's going on in Ukraine. So it's no longer just a pure ECB or European question, and there are many concerns about how this is going to evolve. We have a wonderful panel to try to deal with this. In the middle, Eleni Louri, who is a former Deputy Governor of the Bank of Greece and now a professor at the Athens University of Economic and Business. Some of you have already met Boris Vucic, the Governor of the Croatian National Bank, and I leaned on my good friend Gabriel Glöckler, who's from the European Central Bank, where he spends a lot of his time speaking on behalf of the bank and trying to craft the messages that come out. They are excellent speakers. It's going to be very difficult to contain them to the remaining 43 and a bit minutes, but nevertheless, I'm going to make an effort to open the floor very briefly to the audience, and this requires discipline on the part of the audience. No speeches, a simple question, or at most, a very, very short comment. If anybody abuses this, they will be cut off. So without further ado, what I want to do is to go through three main introductory topics and have an exchange among the panel about those topics. The first one is going to go to Boris. We've seen a return of inflationary pressures. It's been said up to now that these are transitional, that they will all disappear quite neatly. Should we take this seriously? Should we not believe that inflation is now becoming entrenched and therefore something has to be done about it? And that may mean having to react far more than central banks have been prepared to do up to now. Boris.
Thanks. And with the risk of repeating a bit of what I said earlier today, I would say that what we've seen even before the start of the conflict in Ukraine was at the beginning of this year, January, February, revisions or planned revisions of the forecast for the inflation. So even without what we're seeing now in Ukraine, it was clear that the inflation will be higher than predicted by most of the central banks and even private sector forecasters at the end of the last year. Primarily because of the energy prices. Energy prices consist most of the increase in the inflation and overall commodities prices. And then the conflict in Ukraine only added to that and further contributed to the increase in the commodity prices and forecasts of the inflation. So what we're seeing right now is a situation which is still very uncertain because it also depends now on the length and the intensity, length of the war in Ukraine and the intensity of the sanctions and how they will shape the future prices of the commodities in the first place. Food, very importantly also because of the production, not only of the production of oil and gas, which comes from Russia, but also primarily wheat, which comes from both of these countries. But one can say that for sure we know that the inflation will last longer and will peak at the higher levels than was thought of before. Now, having said that, the risks of higher inflation are always that the expectations by the companies of higher inflation translate into the different pricing behavior than they had before. And if they do, then we know that the inflation can become entrenched in a way when it's more difficult to deal with it and when dealing with the higher inflation requires a tougher monetary policy actions. Whether we are there or not is very difficult to say because we don't know much about how the companies form the expectations and how that will affect the inflation in the future. And I can elaborate on that more later on if you want me to. Well, what we do know is the evidence that we have from the times of a lower inflation, where it was clear that both the business and consumer inflation expectations more followed the actual inflation than predicted the future inflation. However, basically empirical work and the surveys that we have pertain to the period when the inflation rate was low, last decade or so, when the inflation rate was close to 0 or 1%. And we know, on the other hand, that as the inflation rate increases, it starts to affect the behavior of both the consumers and the companies in a different way. And more companies start to build their inflation expectations into their pricing behavior. When it comes to the wage bargaining, there I would say the situation is a little bit different. It's not the classical wage bargaining of the past that we had, because there is less and less collective bargaining that we're seeing, and more of the labor market decisions by both the companies and the employees, which are taken, I would say, individually. But if the inflation rate does affect significantly standard of living of the employees, then we can also expect that it translates into the higher wages. And actually what we're seeing, particularly in the Central and East Europe, is already relatively high wage increases that we're seeing right now.
Gabriel, you've spent so much time crafting press releases and trying to calibrate what to say in the press conferences of the ECB. What message do you think we should be hearing now? Is inflation now entrenched, or is it still transitory?
That's a very tough question, and I think we should all await the next press conference, which is next Thursday, when Christine Lagarde will report on what the Governing Council will have decided. But I think there's one thing we have to watch out in this particular case is, are there some factors that look transitory now, but are actually structural changes to the economy? And one of them, for example, is the onshoring, the nearshoring, the friendshoring, so to speak, some of these words that have been made. Now that basically the lid that was on prices that came from outsourcing, from offshoring, is not there anymore. So maybe that's a persistent thing that will be with us. Same story about the labor market. We had lots of people in job retention schemes that basically froze an element of the labor market. Now the job retention schemes are being wound down, and then people come back, and so that the normal kind of functioning of the labor market resumes. And with this, we might have a catching up effect. So these are things to watch very, very carefully.
Thank you. Eleni, since you are now liberated from being a policymaker, I'm curious to know whether you think these days you would be advocating a rise in interest rates.
That's exactly what I was thinking, that it's good I'm here, because there are two people working at central banks. I don't work at a central bank anymore, so I'm liberated, as you said. So yes, I believe inflation is not transitory anymore. There are elements there which seem to last. So I believe that, ECB has to be very cautious, but once it stops net asset purchases, probably there is time for some hike. I don't know, 1 or 2. Markets seem to see more than even 2 or 3 hikes, but I believe there has to be a signal from the ECB, and the ECB has to keep its credibility. So you cannot really pretend this is transitory once it shows we are stuck with it. So I believe we'll see some hikes in the second half of the year.
If I accept the tone coming to me from the speakers, the time to act is coming soon. Boris, for a few months still, you're going to be an outsider from the Governing Council. Let's hope that will change in the next year or so, as you and I both hope. If you were trying to guess the future trajectory of inflation, would you say we should be expecting 4, 5, 6% over the next 2 or 3 years, or will it come back down again?
Well, if you look at the current forecasts, they show that we will see the inflation rate somewhere between probably 5.5% and 6% this year.
Forecasts are not worth the paper they're written on.
Oh, okay. Well, but we have to do it. And you're asking me about the forecast, so I have to refer to it. And then that it will quickly, in 2023, basically come down towards the target, 2 point something. Of course, you have different scenarios, some in which it does follow that trajectory, others in which it follows a trajectory of higher inflation both this year and in the 2023-24. But I would expect that if we do not have, primarily I would say, intensified sanctions, which would affect Russia to actually supply less of gas and less of oil, which it is not doing right now, as I said before. If you look at the Russian exports, they are at the level that they were before. But if that gets seriously reduced through the sanctions, then it will certainly affect the energy prices in such a way that the inflation rate will be higher and will stay higher for a longer period of time. I think that realistically we cannot expect the technology of the substitution of these cheap sources of energy to kick in fast enough to prevent the higher level of the inflation than in the next few years. But let's see, I don't know. There are so many uncertainties that then I cannot say with a certainty where the inflation rate will be this or next year. And you know that I have been personally on the side of those that believe that the inflation rate will be higher, and it is higher, but it's higher than even what I expected. So we tend to get surprised these days, and we really have to be patient and observe what happens and how will it affect the inflation. On the other hand, if you look at the other factor that affects the inflation rate, which was mentioned before, and this is the supply chains, globalization or deglobalization, I think that the risk now, after the conflict in Ukraine, is tilted toward slower recovery of the supply chains as we saw them, because on top of what we've seen during the pandemic, now we have a geopolitical risk. And if anything, that will slow down the normalization of the supply chains and probably affect more onshoring rather than less onshoring, particularly if you have further increase in the tensions between, you can say, not only West and Russia, but maybe East overall, further East. That would add to the more inflation in the next years. And then you have the things that we discussed before, and this is the energy transition, where if we do stick to our goals, that, and we knew that before, will certainly affect also the prices, and also we can expect the higher price pressures. So I would say that the risks, as in my view, tilted to the negative, or however you want to call it, upside on the inflation pressures rather than downside.
Well, we are in Delphi, so I expect that the central bankers present will take the opportunity to go to consult the oracle on this.
Of course.
Let me turn to Eleni now with a different question, which I think is associated with normalization of monetary policy. And that is, by definition, there can only be a single Eurozone monetary policy. There's no escaping that. But what we do see is very different national interests in what that monetary policy ought to be. To characterize it, maybe you won't agree with me, I don't know. The South wants a more cautious approach to normalization. The North, especially some of the Nordic countries and maybe, dare I say, Germany, want a more rapid normalization. Do you worry about these? Can these competing interests be reconciled?
Well, of course, there can only be a single euro area monetary policy, which will have to be applied both by the North and the South. But is there still a big difference between the North and the South? I'm not sure. It seems that in the last two crises, in the most recent crisis, the pandemic and the war in Ukraine, the Union came out much more united than ever before in terms of approach to the problem and to policy measures to be taken. So the old divide, North-South, is not as obvious as we've seen maybe 10 years ago. One can say that maybe there is another divide these days, which is caused by the countries' starting positions with respect to their energy dependence and its effect on their growth prospects. So in spite of the many potential divides, we have to keep in mind that what is important for Europe now is to maintain its cohesion as it is facing an existential challenge. So yes, the hawks at the ECB, or for the hawks at the ECB, inflation is becoming unacceptably high and it must be combated, while for others the war in Ukraine is creating a new threat which will impact growth and will require fiscal increases in public spending. Still, uncertainty and risk prevail for all, for everybody. And as we know, monetary policy is a balancing act. So on the one hand, inflation has been proven to be more persistent, as we said before, than expected initially, especially if we consider the inflationary pressures exercised by the energy, the geopolitical tensions. On the other hand, we also have contractionary effects on economic activity. So monetary policy will have to balance between the two. Now, normalization refers to steps taken to raise interest rates to more normal levels and to reduce securities holdings so as to promote price stability. So this has to be done in a gradual and predictable manner, primarily by stopping new securities buying. So the president of the ECB has stressed the role of uncertainty and underlined the need for optionality, gradualism, and flexibility. So ECB is moving very cautiously as it knows that we are faced with a supply shock and an increase in interest rates is not very effective in calming down inflation unless you induce a heavy recession, which we do not want. So along the normalization path and according to its forward guidance, ECB's net asset purchases are set to end before it hikes. So what do we see? We see the pandemic net purchases program, which has already ended. The asset net purchases program will end by June. So by June, we don't have any net purchases. So then, second half of the year, I think not only me, but the financial markets are convinced that the ECB will hike its base rate. By how much, I don't know, but there has to be a signal. 1 or 2 hikes, I'm not sure, but I'm sure there will be a signal. So should that interest rate hike, bother southern economies? If we follow markets' reasoning and believe their analysis, a 20 or 25 basis points hike would still leave aggregate monetary conditions at accommodative levels. Caution, as we said, is certainly needed, not so because of the debt, but because of the vulnerability of economic activity. So no one would like to face stagflationary conditions, should they come, and least of all, northern European countries that have a very bad memory of such conditions in the past. Actually, it was only yesterday that I saw that the Eurozone PMI survey, Purchasing Managers Index indices surveys, indicated that Germany has the biggest drop in its output expectations index. So, this looks like a recession or a blow to economic activity. That's why Mrs. Lagarde has caution is needed. That's why Mrs. Lagarde is underlining all the time that we have to be flexible when it comes to ECB's decisions. As for the debt, let's all bear in mind that its dynamics are vastly more important when it comes to pricing sovereign risk rather than its level. Of course, the higher the debt, the higher the financing needs may be in normal conditions. But on the other hand, the main condition for debt sustainability is the so-called snowball effect, or in a more formal way, the interest growth differential. To cut a long story short, monetary policy may affect negatively the dynamics of debt after interest rates have exceeded the level of growth rate. So while this is another angle through which one can see the same reasons for caution, with regard to monetary tightening and its effects on growth, it also provides room for reconciliation, to go to Ian's initial question, reconciliation of the different demands from different European regions, north, south, etc. So the condition for a hike on interest rates that does not harm debt dynamics has to do with its effects on the growth rate. So to answer your question, Ian, as long as monetary policy tightening is carried out with caution, so that economic activity is not too negatively affected, it could both have deflationary effects and support debt sustainability. So long answer, but it was a very interesting question.
A very interesting and careful answer. I know that those in Frankfurt have to be careful as well in what they say. But let us into some of the secrets, Gabriel. How much does decision-making in Frankfurt worry about the likely effects on the heavily indebted countries like Italy? And I'll come back to Eleni on Greece. But is it something that causes the decision-makers to pause?
I think the first answer...
I've never known him so quiet.
Yes. I think the first answer clearly is that, the Governing Council has a mandate, and that is to preserve price stability in the Eurozone as a whole. And in that sense, your question, Ian, was a bit, well, as usual, it was trying to incite a little bit of discussion. But of course, everyone who walks into the Governing Council of the ECB has one objective, and that is to look at the Eurozone as a whole and decide what is the right policy for the Eurozone as a whole. I think that it's sometimes misunderstood what the nature of decision-making is. It is not like in Brussels, where people come with national interests, and then there's a bargaining happening and someone leaves the room at 4 a.m. and there is some sort of compromise. No, the idea is to come in and look at the data for the Eurozone as a whole. Of course, everyone with the experience and the background of knowing the home economy particularly well, but the objective is clear, is what is the right policy at this moment in time for the Eurozone to preserve price stability, because that is the mandate.
Boris, let me ask you an equally provocative question. Is the answer to some of this a safe euro asset to relieve the pressure on indebted national treasuries, or indeed fully fledged Eurobonds?
Well, that's an opportunity, as I said before, of the currency union, that it can enable countries to raise debt in a common currency. But in order to get there, we need to have some prerequisites. And the prerequisites in this case are, since we do have different fiscal policies, that these fiscal policies converge to the extent that something like that becomes possible, or at least can be discussed politically. At the moment, we do have a Stability and Growth Pact, which should enable the convergence of fiscal policies and fiscal public debt in particular.
You're an extreme optimist.
No, I'm not an extreme optimist. I'm just saying what instruments we have in place in order to ensure something like that happening. And then whether it's going to happen or not depends on whether the rules are observed or not. If they are observed, that increases the likelihood of more of European safe assets. If it does not, that decreases the probability of having the possibility of raising debt in a common currency. So what I want to say is that we first have to have some kind of the convergence in order to get there.
Your comment, Eleni, particularly in relation to Greece, on whether we need a Eurobond or some other way of resolving the pressures on the Greek treasury.
Okay, about Eurobond, a common European bond. What we've seen from the examples we have, the case of common bond issuances by European states in the context of SURE or recovery and resilience facilities, they were very successful. They've shown that the markets have welcomed this new type of safe asset. So, in fact, markets seem to be thirsty for safety and would lower the cost of funding and provide a boost for investment. So, also, looking forward in this new landscape we are seeing developing, the new landscape will be one of lower globalization, less globalization, and higher inflation, I'm afraid, for quite some time. So productive investments and new infrastructure projects would certainly serve the productivity and competitiveness aim of European policies, of common European policies. So expanding the list of safe assets provided could be seen as a win-win situation for all. So again, now it is the European view everyone should adopt rather than the national one, and a type of Eurobond may be part of the solution or is part of a solution. So now with respect to Greece, well, the dynamics of the Greek public debt offer a high degree of confidence. Interest rates on the Greek debt are fixed and low. I mean, for 90% of it, they are less than 1.4%, and its maturity profile is on average 19 years. So, thus, despite its high level, financing needs are manageable. On top, the liquidity buffers Greece has accumulated suffice for more than 2 years of financing needs without any new bond issuance. So, or the state, or if the state decided to lower its new bond issuances with respect to those of 2020 and 2021, in half, say, in combination with the liquidity buffer, Greece could easily navigate through to 2025. So, of course, the necessary condition here is that government deficits are reduced and the primary balance is restored for Greece. And I think that these conditions are important, not so much in order to avoid risks, but in order to fulfill the aim of being upgraded by the rating agencies to the investment grade, finally, which we've lost since the last more than 10 years. That would be the final step towards reaching a new normal for the Greek economy according to European standards.
So I interpret your remarks to mean cautious optimism for Greece in relation to the sorts of challenges we're talking about. Oh, you don't answer that. Gabriel, you wanted to come in.
I mean, these are just some musings of the central bank. Of course, the decision on this is with governments and politicians and parliaments. But if I ask myself a few questions what a safe asset would do, would it make the job of the central bank easier, for example, in asset purchases? Yes, it would. Would it make our currency more attractive internationally and tap excess savings elsewhere on the planet? Yes, it would. Would it make the crisis response of the Eurozone more resilient? It certainly would. We've seen that common institutions, we've seen it on the monetary pillar of EMU, that common institutions, properly designed and properly legitimated, are probably better at handling especially difficult situations than more rigid rules. So if we just take some of these lessons into account, I think one can come to a conclusion. But this, to put this conclusion into action, that is clearly for governments and politicians and parliaments, the people.
Well, we have a third topic coming up. I'm going to pause now to see if there's a burning question from the floor on what you've heard so far. Antonis, you remember I said it has to be short, otherwise we'll be told to shut up.
All right, as short as they come. Under the current situation, should the utterances of central banks, be they the ECB or national banks, be understandable by the layman, or is it wiser for them to stay a little Delphic? Thank you.
Delphic, that word keeps coming up. Constructive ambiguity or precision? Gabriel, you're probably best placed to answer.
I think there's two elements of this. One is our communication to experts and to the market, where I think there is always and you see this also in the way we communicate, there is an element of constructive ambiguity. But what is absolutely clear, and I think the ECB has taken big strides in this, especially under the presidency of Christine Lagarde, is we must be understood by the people whom we serve. And I think there's now been a redirection, especially of central bank communication, away from just focusing on markets and experts and saying, well, actually, what we're trying to influence in monetary policy is the behavior of people. I mean, Boris spoke earlier about consumers and their expectations. Now, it's difficult to influence consumer expectations if consumers don't know what you're doing and don't understand the reasoning, why we're doing certain things and how we're arguing. And that is precisely, I think, what we have been trying to do, is trying to be more understandable, go out, also listen. Bank of Greece has done some fantastic ECB listens or Bank of Greece listens events to understand what are the expectations, what do the people think their central bank should do, what should be important to the central bank, and to feed this back in the process. I think these are very important things to say. We're not just there for the markets and the experts, we're also there for the people, and to really build trust. And that is, if you want, the biggest capital that a central bank has. The people trust in the job that we're doing and the money that we have, which after all is pieces of printed paper. It's the trust of the people behind it that counts. And to rebuild this and to foster this, we must be able to be understood by the people, and that's what we're trying to do. It's not always easy, because as we hear from this discussion, the situation is complex.
Boris, you speak to and listen to the people of Croatia. Do you do enough to communicate to the ordinary citizen?
Oh, yeah, absolutely. I fully agree with what Gabriel said. I have been doing it for years, and I repeated some things 1,000 times to the public in order for them to understand. And I think it's crucial that people understand why are you doing what you are doing. For example, in our case, it was explaining why we keep the exchange rate stable. When many people were advocating, devaluations, which should be growth promoting, etc., I was explaining why that would not be a wise thing to do. And in the end, after enough of explanation and after repeating the story enough times, people start to understand. Actually, it works. It's just that you have to be really persistent and try to explain it in the plain words so that people can actually understand. But it's crucial. I mean, central banks must do that. I fully agree.
Right. Let's move on to the third topic, and there will be just a.
Okay, but I mean, it has to be. I mean, the central bank has to explain what it's doing, etc. And I mean, in a general context, it can improve financial literacy and things like that. Or when it comes to the specific context of monetary policy, it has to be as clear as possible. On the other hand, we have to keep in mind that the central bank has to have flexibility. So it's not because you say something that this has to be done, notwithstanding changes or changing conditions, etc. So it has to remain flexible. So, and I suppose this is again a different balancing act. I mean, you have to give forward guidance, but on the other hand, you have to keep flexibility. And of course, it's also gradualism. Okay.
There's a famous saying of Alan Greenspan: if you think you understood what I said, you must have misunderstood me. Gabriel, I'm going to turn to you for the third topic, which is, as we all know, that last July the European Central Bank announced a new monetary policy strategy. It's faced some criticism. Does it water down the commitment to price stability, politicise monetary policy, as your old mentor Otmar Issing said, and even put ECB independence at risk? And I know your answer to all these questions is no, but elaborate.
Yes, thanks a lot. Maybe the first thing to answer directly, the commitment to price stability was never in question because that's in the treaty and that is the job that we have to do. But what we did have to do is ask ourselves whether our tools and the way we look at the economy is still fit for purpose. And that's why we did this strategy review and asked pretty fundamental questions. I mean, Christine Lagarde said we leave no stone unturned. And that's what we did with a very thorough analysis on a whole lot of topics. Are we measuring the right kind of things? Are we aiming at the right kind of thing? Are there other things that we should take into account, like climate change, inequality, growth? Are we speaking the right language to the people? Are we being understood well? Are our tools, many of which have been unconventional, maybe they're now all becoming conventional? So there's been very profound questioning because the topic is about the new normal. In a sense, with the strategy review, the ECB has been thinking, how has the world changed and are we still fit for purpose with this? And I think to sum up the strategy review, it's 2,136 pages of analysis, which you can find on our website. So I don't going to go into details there, but I think it's clear that there's a couple of things that become much clearer. I think we've become much clearer about what we're aiming at, and that is a 2% target that is symmetric and to be achieved over the medium term. We've also become clearer about how we measure this by, for example, including owner-occupied housing, so an element of what's happening in housing markets, into our measurement. We've made clear that what served us well, like quantitative easing, has been a good tool, so we keep it in our toolbox, even though the main tool will remain interest rates. The second big thing I think was become clearer is what monetary policy can achieve and where it needs to interact with other policies. And of course, the key element here is fiscal policy, where I think the relationship has been looked at again in terms of understanding that when interest rates are near the zero lower bound, when they're so low, it is when fiscal policy is particularly effective. And to recognize that, I think, has been a big thing. And that, especially in crisis response, monetary policy and fiscal policy working hand in hand has been much more effective in stabilizing the economy and doing, so to speak, the right thing. A third element in this context also, what are other policies that people worry about? Real estate prices. Is monetary policy the right tool to respond to that when you have specific overheating in specific markets in specific countries? Maybe there's other tools, macroprudential policy, and there's a much better understanding of this. Final point, Ian, is we're much clearer who we need to speak to, and that's what we discussed. We've got to speak more to the people to make sure we are being understood and actually can be effective with our policy.
But Boris, does it make sense for central bankers to get involved in climate change policy?
I think everybody has to get involved into climate change. It's such a big issue that everybody has to sit down and say, okay, this is what we can do here. The question is what the central banks can do. I don't think we can do a lot, but we can do our fair part in the fight for avoiding the climate change that we are seeing at the moment. There we have to be realistic. It's up to the governments to do the most, and we can play a support role, which we will play to the extent that we can do it, but we cannot be the main player in that game.
Eleni, in your new liberated position, do you fear that central bank independence is being eroded by these new monetary policy strategies, or on the contrary, is it a good idea to erode central bank independence?
No, it's not a good idea to erode the central bank independence. No, not at all. But I don't believe that the new strategy and the introduction of other goals are affecting, the main goal, which is price stability. So, and the world is changing. So, price stability should be the main target. On the other hand, climate change affects risks, and risks affect, the whole banking system. So it depends how you see it, of course, but I believe that it's a good thing the central bank is involved into climate change, into green financing, and maybe they cannot do much, as we said, but they give a signal that this is important, and markets follow usually. So I believe, it's a very good thing that climate change has been introduced.
That's a very, very firm answers. Now, as promised, an opportunity for 2 questions from the floor. Again, I have to insist that you be precise and short. Right at the back. Okay. And then here. Yes.
Okay. I have one question. Since the biggest part of inflation increase is not due to people's hugely better prosperity, it's due to supply chain problems, and yes, people have saved money during the pandemic and they spend them now, but the main, I think, problem is supply chains problems, and now the energy crisis in Ukraine. My question is, should central banks take that increase as a sign to raise interest rates in the name of stable prices?
Okay, understood. Creon, I think you had a question. And then one very short one, Jens.
Thanks very much. A very quick question. When we used to talk about new normal, before the pandemic, we were thinking about the consequences of the financial crisis and how it changed the way the economy worked. We've had the pandemic. What things do you think the pandemic could permanently change about the economy, which central banks are going to have to take account to in the way they set strategy?
And very, very quickly over here, you could throw the microphone to him.
Question to Boris. In light of the challenges that you've all described, does it impact your roadmap regarding Croatia's adoption of the euro?
Boris, why don't you start with that one?
No, it doesn't at all. I mean, what we've seen and what we're seeing in, I would say, any crisis, be it a pandemic or the war now in Ukraine, is that it makes more sense for us to be the part of the Eurozone than to be outside of the Eurozone. So on top of the usual discussions on the costs and benefits, you see that the reaction of the central banks of Central and East Europe, which are out of the Eurozone at the beginning of the pandemics, spring 2020, as well as now, spring 2022, has been very different than what the ECB did or what we do as a part of the ERM. As I said before, you have the interest rates now in Czech Republic, Hungary, Poland, which are 4.7%, 3.8%, 3.5%. And that makes a really big difference whether you are the part of the Eurozone or not. Also,
so,
if you look at the
Boris,
availability
I have to
of
cut you short. I think your answer doesn't interrupt you.
Yep.
Eleni, on inflation when it comes from the supply side, do you react to it or not?
I believe we discussed it in the first part of the discussion.
But just to reiterate very quickly.
If the central bank believes that this is the inflation is not transitory, as we said, but it's entrenched, then it has to give a signal, which means, stop buying assets and, increase interest rates. So yes, they have to do it.
And the last word, can you say something about the pandemic in 10 seconds?
In 10 seconds, it's quite impossible, but I think some elements like supply chains, more security in supply chains, I think changes in the labor market, these are the kind of things that will have an impact that we have to take into account. And in fact, were already looked at also as part of our strategy review. So papers are there. Thanks.
Right. With that, we're very close to finishing on time. So I think I expect the whole hall to thank us and to thank the panel in particular for their very rich answers in the usual manner.